Hello everyone, welcome to Stoic Talks. Today we have with us Mr. Keshav Garg, the Director of Counter-Cyclical Investments PMS. His expertise lies in spotting and investing in promising small cap and micro cap companies. His passion is in interacting with management, attending as many AGMs as he can, visiting plants, doing channel checks, and then making up an investment case. In this episode, we delve deeper into his investing style, processes, and how he picks these potential micro cap companies. So let's welcome Keshav here. So Keshav, uh, before we start on in depth on investing and everything, let us know how did you get into the markets in the first place, and how did it start out of?
So Nuresh, I way back when I was in college in Ferguson in around 2004, when I started reading Economic Times, and those days with Economic Times, a supplement used to come in which all the stock prices were there, and plus market cap and P ratio was given, and I think 52-week high low was also given. So I just started having a look at that what is this all about. And I remember I first read in Economic Times itself that has declared a dividend of 300%. So I was really amazed that isn't this great that you buy something and you get 300% dividend. So I had no clue that the dividend was on the face value, and since I was not from a commerce background, so but that's what basically triggered my interest. And the first thing I remember was to understand the P ratio, since it was mentioned in that ET Economic Times supplement. So, and I understood that concept, that price to earning is, I mean, how many times the profits the company is trading at. So that was the first thing probably I understood, and for many years, that was the only thing I understood. And I had no clue about cyclically adjusted PE. I just understood PE. So whatever low PE is there, that is it is good, and high PE is bad. That was my understanding for many years. And gradually, and basically, so I used to, and since that period coincided with the huge bull market from 2004 to 2008, so I used to dabble in stocks starting 2005 or thereabouts, and I used to apply in IPOs. And since during that time all listings used to be like bumper listings, so I used to think that I am a genius and that I know everything and it is so easy to make money in this market. So how it went that in 2007, I was a total tech investor. So I had all the tech stocks and all fraud stocks. All I don't want to take names, but basically all of them are presently now penny stocks. But at that time when I was buying these stocks, I used to think that this is the future that I'm buying, and probably these stocks are the next. And so I didn't used to, but I used to read about economics and everything, uh, but I really didn't know much about the stock markets. And only when the 2008 crash happened, and then since my portfolio was deep in red, then I thought that and at that time I used to run a very concentrated portfolio of all these hanky panky tech stocks. And so when in 2008 the market crashed, then my largest holding used to be this company came out with an IPO in 2007, and they raised 30 crores, and for purportedly for setting up a enzyme plant,
Okay.
which was some 40-50 kilometers away from Hyderabad. So I had put approximately half of my portfolio in this company itself. So, and all I knew about this company was it was setting up an enzyme plant, and also that it was into bioinformatics. And what is
Okay.
bioinformatics? That biotech plus IT is bioinformatics. So I thought that this is a great thing and the future belongs to this company. So in 2008, when the stock crashed along with the market, so I went to Hyderabad where my friend was based, and together we took his car and went to Genome Valley, and we were roaming around in the Genome Valley asking people that where is enzyme plant. So we couldn't find that plant till evening, and in the evening our car met with an accident. So it was a total loss. Not only could we find the enzyme plant, our car also got damaged. So in any case, so after the shock of 2008-9, then I started, basically I read security analysis, I read intelligent investor, and I started reading annual reports. I read Warren Buffett's letters to shareholders, and since the beginning only my inclination was always towards fundamental investing. So, and that's how then, basically, since I have never worked in any organization, so it was all bottoms up, trial and error. So that's how I was since the beginning in the small cap end of the market. And in 2009, once the markets turned around, I exited all my Katra stocks, which are now penny stocks. And then I started buying high quality companies. And high quality, I won't say high quality companies. I mean, at least
Not
genuine
frauds.
companies trading at huge, basically cigar butt valuations. So, and then I started basically running a diversified portfolio. Then, by a stroke of luck, in 2011, I came across this company, and myself and my friend, we went to the AGM, and the promoter was there was hardly anybody in the AGM, so the promoter gave us time. He explained us the business, and basically the situation was that the stock was trading at some 4-5 times PE, and it had got some 4% or thereabout dividend yield, and the growth was amazing from that base. And the promoter said that I'm the largest synthetic leather manufacturer in India, and clients are queuing up outside my office. They want more supplies, but I'm not interested in expanding capacity and catering to the low quality domestic market. I'm trying to sell this in US to international auto OEMs at 3 times the realization. So, I mean, it was very easy to understand that normally selling is the hard part, not manufacturing. But you need to be able to sell as much as you are producing. But here the situation was opposite, that the customers wanted more, but he was not interested in just expanding capacity and expanding sales of low realization products. He wanted to enter the US market, in which the realizations were triple. So that's probably that was one of the few times I took a really big bet, and it was actually a no-brainer because at those valuations and after having met the promoter, uh, so it was, I think, at peak was 45% of my portfolio, and since then there has never been any stock which has come anywhere near close to that kind of concentration in my portfolio. So basically I would still say that it was my lucky break, and that's what basically helped me build seed capital. And I don't think, although today, relatively speaking, today I know far more than what I knew in 2011, but I have not got, I still consider myself lucky, but I have not got as lucky as to find anything like ever since.
So you ended up being full-time investing right away, or you were doing something else also all through this period after studying?
So Nuresh, I'm from a business background, business family, and so job and everything was never in an option. So it was always that either I would do something on my own or I would join my dad's business. So yeah, basically in 2008-9 was the time when the crash happened. If I had to exit, I would have exited at that time and gone home. So, but since that did not happen, so yeah, because the weak hands in the bear market, they throw in the towel and just leave the markets. And those who stay back, I think they stay back forever.
So that is the time you became extremely devoted towards markets as a full-time vocation. you would say?
Actually, Nurish, I'm always a one-track mind only. So I have very few interests in life. So whatever I have, I just, even if I listen a good track, or a good song, so I just keep on listening to that until I'm listened it to hundreds of time, and that's when I'm done with it. So I think, yeah, so that's what it is.
Keshav, let's add a bit timeline to this whole thing. So 2008-9, when you saw the crash, or when you were participating in that crash with the app you mentioned. So at that time, this was during your college days, or you were already through with your college? Just to add
Yeah,
some timelines
I
to
had
this.
I had completed my college, and I think I completed my college in 2006.
2006 graduation year.
Yeah.
Now,
So 2007,
as
I was busy with the bull market. I thought that what's the need to do anything? I'm anyway making money, and I had shares and so on, and yeah.
since you mentioned that you are non-commerce background and you were making money in 2007 because of the bull market, probably learning accounting was never in the top of your of your agendas. So when did you realize that you also need to probably build some understanding on accounts front, and or do you think it's important as people make it too?
It is very important, and the thing is that since I did no formal commerce education, so I read security analysis and I couldn't understand much of it, and I read it twice or thrice. And intelligent investor, I could easily understand that, and thereafter I just started reading annual reports. And in the beginning, I didn't used to understand anything, since I didn't even know what is inventory, what is receivable. But yeah, if you just keep on doing something, then it automatically you start understanding it. And I think that's a far better way. I would not say far better. I'm sure that people who have actually read commerce, have done commerce, they must be it must be far easier for them, and I think that's the correct way to do it. But I don't think it's a roadblock as such. I don't think it is let's say a kind of let's say medical. You cannot become a doctor yourself. I mean, you can become knowledgeable, but I don't think you can. I mean, how will you learn how to operate on your own and so on? But I don't think in stock market it is. I mean, that complex. I mean, basically all accounting. And what I do, I just stick with simple companies. I like companies who have no subsidiaries. I don't much like consolidated numbers. Actually, it becomes a leap of faith. I mean, if you look at conglomerates who have got engineering, insurance, and then they are making a consolidated balance sheet, then I mean, how much it's really hard to find head and tail. So I just stick with simple businesses which I can understand. And since in any case we run a diversified portfolio, so I don't like a company which has got 3-4 pages of notes to accounts and so on. So simple company, standalone business is what I like.
But that would leave very few companies nowadays, no? Because from what we have observed over a period of time, companies have also hired IRs, and even smaller companies and mid cap, small cap names. The annual report sizes have gone from some 30-40 pages to 200 pages, and it has become a fashion to have good annual reports and jargon from Warren Buffett and so on and so forth within the annual reports itself. So uh, let us I mean, when you say you invest in simple business, let's dwell down a bit more on your current style of picking stocks, right? So when you say simple businesses, one part is the business operations part, which is simple, but do you have some very quick rejection criteria? For example, just like you said, no subsidiaries or something like that, no
No,
consolidated or
look, it's not a hard and fast rule that there should be no subsidiary. The thing is that if it is making sense, and if it is a wholly owned subsidiary, then it's not a deal breaker. Like many good companies, if you see, they have got wholly owned marketing subsidiaries abroad, so that in the front end they have the a white man sitting over there, which basically deals with the customers and the back end they have outsourced. The basically manufacturing is being done from India, and all that makes sense. Companies have subsidiaries which have warehouses in foreign locations and so on. But you see now what happens, that in companies in which they have multiple subsidiaries, in which they are not wholly owned. Okay, so then what happens? There might cash might be in some. Let's take example of. I mean, just for example's sake, we have no position over there. So they have a major subsidiary in Thailand in which they own 51%. The parent company owns 51%. So the most of the cash is in the foreign subsidiary, right? So if you look at the consolidated balance sheet, they will include the full cash with the subsidiary, even though they are holding 51%. So in the net worth, they will subtract the minority interest. But if you look at the consolidated cash balance, and if you set it off with their consolidated debt, you will think that it's debt free. Now, same is the case with also. But actually, if you see, the company is not debt free, because company is including 100% of the cash of subsidiary, whereas it owns only 51%. Similarly, if you look at the operating cash flow statement, the minority interest is not being subtracted. So if you look at, let's say, a company like which is not, now it is trading at prima facie 10 times consolidated operating cash flow, right? But if you take out the minority, the all that cash flow does not belong to the parent company. It belongs, the minority interest has not been subtracted, and if you do that, then the picture changes. The stock is not as cheap as it looks. So what I'm trying to say, that I try to avoid these complications, and I prefer companies which are simple. Like if a company unnecessarily has got multiple subsidiaries, then I mean I take it as a negative.
Sure. Actually, I mean, when I said subsidiary, that was just a point because you mentioned, but my question was more towards, do you have some strict criteria for not considering the company at the first place? For example, if this company has, let's say, high receivables, I'm not interested in the company or something like that. So is there a negative sort of checklist where these kind of companies I'm not interested in at all? And then you start with the companies which are remaining. Is there something like that, or you start
Yeah,
with
so there is something like that. So let's say BFSI, I don't invest. I don't understand BFSI lending business. Anyway, I'm not a big fan. And how do I know that? Okay, today the books might be clean, but tomorrow the bank might give some bad loan. How would I come to know? I will only come to know when that bad loan gets recognized and so on. So basically, lending business, BFSI we don't touch. Gems and jewelry we don't touch. Then technology, I think it is beyond my. They are far smarter people from IITs and so on, who understand much more technology of a newer generation, who have a edge, because I'm an old school person. So I don't want to play a game where the field is tilted against me. So these are the sectors that we stay away, and more or less real estate also you can include pure play real estate. Apart from that, yeah, I mean it depends upon case by case, company to company. The main thing is, even if there is any, let's say there is a issue of corporate governance, that look, corporate governance also very hard to define. That, I mean, what magnitude of corporate governance is the whole business fraud, like in the case of so on, there's no business. Or is it that the business is real but the promoter doesn't want to share? Like, there are many good companies in the market with strong businesses. The only thing is that the promoter will not doesn't want the money to go out of the company. He just wants to the business to grow, but he doesn't want the money to go. He will never do a share buyback no matter what the price of the share goes, and the payout ratio will always remain low. So if the company becomes debt free, he will diversify into something, but he'll not pay out. So whenever that kind of a company is there, so we take it. There are two ways how we basically adjust. Firstly is the valuation. So is the valuation low enough to basically compensate for low dividend payout? And second thing is, the allocation that we will make in that company will always be low. So it will never become a major position. So that's how we basically, if the is it whatever the negative is it factored in the stock price? If it is, then we are happy to take a small position, but we'll never take a large position in such companies in which the promoter either doesn't have the heart to give a to make a big payout, or will never do a share buyback. And there are many such companies in the market.
Can you put a number to that? When you say low allocation, what do you mean by in the portfolio context?
I mean, look, we have over 100 companies in our portfolio. So that means median position would be like, let's say, 1%. So you can say point something percent. It also depends upon what kind of valuation the company is trading at, what are the triggers, if there is some near term trigger, if we think that earnings have bottomed out. So then we can maybe take a slightly larger position, but it will never become like, let's say, top five or a significant allocation.
Actually, 100 companies is surprisingly large number. Matlab, from somebody who manages professional money, I've rarely talked to anybody who has 100 companies in portfolio. But anyway, we'll come to portfolio construction and allocation later on. Nuresh, carry on with your question. You had something.
Yeah, so it's interesting to see that in your website also you've clearly mentioned no BFSI, no real estate. So you've mentioned a lot of no's. And say, going back to the point of 2011, so is it that, say, from the time of or that debacle in the 2007, you've been attending AGMs all through the last many years, and that has been one of your strategies. That is how we met also. So say that was 2011. So what was the next 10, 12 years? As in, how did you shape up differently in those years?
Actually, from 2009 onwards, only I started attending as many AGMs I could. Any good company I used to come across, I used to buy one share, and then I used to go through the annual report, try to attend the AGM. I think in 2018-19, during the last 15 days of September, except for weekends, I didn't sleep in one city for 2 nights. So I was traveling because most of the AGMs were bunched up. So I travel a lot. I mean, I used to pre-COVID and try to attend as many AGMs as possible. I think even post-COVID, we are, if anything, attending more AGMs. But then the productivity per AGM, I mean, in a physical AGM is far more. I mean, if you go to a company in Rajkot and you are the only person who has come from 20 years, so the promoter also thinks that someone has taken the pain to come all the way from Pune. And if he has done his homework, if he's asking some reasonable questions, then they also don't mind sharing information or describing their business or what they think about it and so on. So basically, that helps definitely, especially in the small cap side of the market. So after attending a AGM, since you go there and ask whatever apprehensions or basically potential red flags are there, you want to know the perspective of the management. So after that, either you can just take that company, strike it off that, okay, this company, I'll not waste my time on this company now. Or then you can, if it's a good company, even if the valuations are unattractive at that point of time, I keep on tracking that company, and sometime in the future, maybe years later, whenever I can find that company at an attractive enough valuation, when the business is going through a temporary down cycle, that is the time when we buy.
Actually, Keshav, it's a very interesting point you made, and I'll probably dwell a bit more on that. Has there been cases where you found the initial study of company to be very attractive? Let's say the numbers and the financials were all looking good, but post AGM attendance or post meeting the management, you changed your mind entirely. Basically the idea here.
The promoter can have plans. If the promoter says that I want to acquire something, I go to the AGM and ask for a share buyback. And if the promoter says that I want to diversify into EV, I will sell the stock.
Okay. So, but you would have already bought the company and then at a small tracking position, and then you probably sell it after if you're not convinced with the plans. Is that what you're saying?
Mostly it's due to capital allocation. If the promoter wants to, like, now battery EV is the new craze, just like 10 years, 12 years back, power was the craze. Every Tom, Dick and Harry was getting into power. Now everybody is getting into EV and battery. So I mean, so, i- if basically we think that the I want to buy companies in which the promoter is doing share buyback. So because that is the litmus test for me, that firstly the business is generating that kind of cash, otherwise your bankers won't let you do a share buyback. So firstly the business should be generating that kind of cash flow. Secondly, the promoter should be having that heart that he's ready to distribute that kind of money. So now if you look at, again, it's not a recommendation, but I'm just trying to cite this example, that since company has done 5 share buybacks, and since the past 2 years they are doing open market buyback, and he's distributing 10% of his net worth to minority shareholders, and his shareholding is only increasing. So now there are so many companies, well-known companies, that don't have 10% dividend payout ratio. So from their profit, they cannot pay 10%, and here 10% of net worth he is paying out. So I would definitely give some weightage to that. And I don't know what this, in this all the conference call and everything, there are so many companies in which the people are totally obsessed ki they are uh, getting into intricacies, that what is this bifurcation, wahan se kya aa raha hai, wahan se kya. Yeah, when the what will you do with the profit if it's not going to come to you? So since most of the people who attend concalls and all, they are just doing their job, they have been told ki go and attend that call. So that's why and that's why you will never hear people asking for share buyback or increasing dividend. They just want to know ki kya margin hone wala hai aur kya volume hone wala hai, and so on and so forth. I mean, but what's that? I mean, agar what will you do with that if that money is not coming to you ultimately?
So, Keshav, actually, the point you're making is pretty valid, and I've also seen over a period of time a lot of change has happened in the way this information which you're seeking from the promoters. Have you seen, in your experience, since you've been doing this from 2011 onwards, from time attending AGMs and all? Earlier, attending AGM pretty much was very important to get this kind of information. But with time, these information about companies' plans, what the management wants to do with the cash, or plans for any other asset which is lying on idle assets, is more available, more public. Information is available in forums. A lot of people do. As you said, con calls is now something which many companies do. So, have you seen AGM's relevance going down over a period of time in your experience, or something else you get from AGMs which you otherwise can't get at all from other sources like con calls?
So the companies that do con calls, I don't want to attend their AGM until I want to ask for a buyback and so on. But mostly, if the company is already doing con call, then why waste time in the AGM? So that is there, of course. But mostly, what in AGM, the benefit is that if I have attended some AGMs, like many companies AGMs, I have attended like maybe 10 times in the past 15 years. So whatever the promoter told me that this is going to happen, how much of it happened subsequently? So basically, if you listen to a management for the first time, then you have to take him at face value. I mean, okay, you can look at the past figures, and then in that context you can try to see whether what he's saying, has he done it in the past, or he's just talking out of his hat. But still, the point is that, but if you have met someone in the past, so you know that this guy kaun kitna bolta hai. Some people are just boastful, some people are just overtly optimistic, and some people, they just tell jaisa hai, they call a spade. They're a very tiny company based in Coimbatore, in which I had bought this stock at 90 rupees. Then the stock went to 240 and I sold it. And then again the results, bad results started coming out, and again the stock fell below 90. So I thought that the company is good. I have already met the promoter and I've seen the plant and everything. So maybe it's a cyclical downturn and company will be fine. So what happened that incidentally there was a EGM for name change of that company. So I went to that EGM and the promoter, I asked him that, sir, what is happening? So he said that 5 new fully automated plants for 200 crore each have come up in China. So I've had to slash my prices by 20%. So my business is as good as finished. So he told me in as many words. So now they are, most promoters will never say this. They will just say, नहीं नहीं हम तो कर रहे हैं, चेष्टा कर रहे हैं, होगा. They will never say this. They will not even tell you that they have reduced their prices by 20%. So now this kind of management who tells upfront the negative news, and so that I give weightage. So whenever in future, if he gives a upbeat guidance, I will take it at face value, because I know that from past experience that, I mean, there are so many people, they only talk good. कि सब अच्छी बात करेंगे, otherwise they'll stop doing con call or they'll stop whatever. Even in the AGM, they'll not answer much.
So, how many AGMs do you attend in a general year?
I think post COVID online AGM, there is no count of AGMs. I think in last day of September, I must have be attending 10 AGMs. How? Because many AGMs are going on simultaneously, so I open them, and if in one AGM some shareholder is making speech or some introduction is going on, so I mute it. And but actually it works. Like in the first COVID year 2020, I just heard for 2 minutes call in which the promoter just said that this is the best year in tea industry in my 25 years. So rest I didn't hear anything in that AGM, but that takeaway was enough to know that this year is going to be good for the tea industry. So I mean, it you see, maybe out of 10 AGMs you attend, maybe in one or two you will find something worthwhile, and others are just effort that you put.
So, pre-COVID, how many AGMs would you generally attend? Physically.
Physically, let's say maybe some 60, 70 or something like that.
Hi, friends. I hope you're enjoying this particular episode. I just want to take a minute and thank the sponsors for this episode. Stoic Talks was built on a premise of actionable insights and detailed questioning, and that usually requires the independence of doing that work. When you're looking for somebody to partner with, you are not only looking for somebody who will share your ethos, but also will promote this independence of asking fearless questions without any hesitations. So when we were looking for someone like that, the obvious first choice for me was a DSP mutual fund. I have known their team. I have worked with them for a long period of time. You know, they have this tagline called hashtag invest for good, which I really like because it really associates, which in my observation, I have seen them living this as the way of their life, and which is very visible. If you follow their work in public, they have done some excellent research efforts. They've come up with some amazing reports which everybody enjoys reading. For example, they have this report called Netra. Then there is the transcript, which talks about the con call transcripts. Then there is the annual report Nectar, the Navigator, and many such reports which I enjoy reading and is enjoyed by many practitioners in the investment community. So we are extremely proud to be working with such a team. They completely agree with our vision for Stoic Talks, and I really want to thank them for supporting this particular episode. And if you aren't already, I would highly recommend you to follow them on Twitter. With their Twitter ID is @DSPMF. So thanks once again, and enjoy listening to this show. Keshav, let's now dwell down a bit into your portfolio management style. You manage a portfolio for clients, and in your portfolio you keep a lot of companies, as you said. Is that for that portfolio also you're talking about when you say 100 odd companies? Is it fair to assume
I'm
that?
talking about our PMS, the consolidated
Sure.
portfolio.
So before we start that, when did you start managing other people's money? Say roughly, because the data online available is for the last 3 years. But when did you start, say, even friends and family, or you were on your own money only for the long period of time?
Yeah, so basically around 2010, I took over. Even before that, I had a small portfolio. But around 2010, I took over my dad's mutual fund portfolio of around 2 crores and I liquidated it and I started actively managing it. And around 2018, I thought actually 2014 to 2018 was my golden period when basically my portfolio went from around less than 4 crore in November 2013 to 55 crore in January 2018. So that is the time when I thought that we can really, I mean, again, overconfidence came, and I thought that we can, I can easily handle other people's money. I just need to buy the same shares since I was anyway doing research for my family portfolio. So yeah, actually there was a huge bubble in small caps in 2017. So I knew that there was a bubble, but I just what I did, I just since I was always covering a lot of companies. So from 2014 to 18, since there was a huge small cap bull run, so I could sell what I had and I could buy other stocks and then I could sell those and switch on to something else. And finally, when everything was expensive, I was stuck with all the kachra companies because at the top of the bull market, only crap is cheap. And that's what I finally uh, bought. So yeah, so basically to answer a question, in 2018 I decided that we can convert this into a PMS. Since my own family portfolio was also significant, that I thought it would justify the expenses of a PMS and so on. So yeah, that's when we started the procedure and we launched in July of 2019.
Got it. Got it. So, yeah. So coming to that operational part of your PMS, given the fact that you have close to 100 odd companies in your portfolio, so it's a pretty diversified. First, let me actually take a reverse path. Instead of going to stocks, let me first understand the allocation. What would be, let's say top 5 companies or top 10 companies allocation, just to get an idea of how spread, how thinly or how thickly you're spread.
Top five would be approximately 30%, 30 to
Top five would be
35%.
30%. Okay, okay. And
Approx.
so is it fair to say that close to 80 odd companies or maybe 80-85 companies will be very very small in terms of your allocation percentage wise, less than
I
a
mean, you
percent
see,
maybe?
the it is dynamic. The smallest position can ultimately become the largest position also, and vice versa.
Sure, sure.
So,
No, I mean
so
at any
that,
given point in time, given that you have large companies and top 5 takes 30%, so it's fair to assume that a large set of companies will be very very slow, very very low allocations, touching
that's
less
it.
than a percentage or so on and so forth, right?
Yes, yes, that is very true. Some of it is due to that. Firstly, we don't follow any model portfolio, so we buy whatever is the best opportunity at that point of time when the we have funds available. Second thing is that since there is no lower limit that below which we will not go in terms of market cap, if the company is fitting our criteria in terms of corporate governance, valuation, business quality, and so on. So now what happens that if I am buying something and if the stock goes up, so what many people will do, especially those who follow model portfolio, either they will totally sell and exit that stock, or then they will continue to buy at higher prices. And if you are buying at higher prices, then you have to basically come to terms with basically accepting lower returns. So what we do, we stop buying. If something, I'm not talking about the price, I'm talking about the valuation. So if I'm buying something and if the stock goes up dramatically, like let's say from March until today, many stocks have doubled. So now what I might do, if I was buying 1,000 shares, I might be buying 250 shares now, if at all I'm buying. Now, second thing is that since these micro caps liquidity is a big issue, and if I continue to buy them, my own buying will drive them up. So that is another reason that I don't chase the stocks. And since we spread our net very wide, so they are always companies that of similar quality and now cheaper valuation, because now that the stock that I was earlier buying has gone up, so there are other companies which are of similar quality and now which are of lower valuations. So so we will basically start buying those. So that's why the portfolio gets diversified. So we don't mind even if a stock has got 0.1% allocation. I will not just sell it if I don't think that I'm getting good value for the stock. I'm happy to hold 0.1%
So
allocation in
actually,
that.
yeah. So the way what I'm interpreting from you is that you don't have an allocation in mind when you're going for buying. There is a company you like. If you have some cash lying around or you're selling something, you will probably end up buying this company with whatever amount you have in your portfolios. It doesn't matter if it means 0.1% or 1% because you like the company. That's okay. That's understandable. First, actually, I have one question which is bugging me for long. Is this: do you really find 100 companies with good corporate governance, or a large chunk of those companies are actually in the lower segment, which not many people are looking at? I mean, what is your hunting ground? From what I'm hearing, I can guess that you're not too much into the most followed large cap big names, but primarily towards the small cap, micro cap names. Because if you want to do that kind of buying, which you're saying, that is the only space where you'll find it. Is that a fair understanding, or do you want to add something to this?
No, that's a fair understanding. The only thing is that I like companies which are thinly traded. So, because especially always one should be beware of highly liquid small caps. That it's a small company and yet there is so much investor interest. And if there are such huge volumes, then I mean there's such huge market participation, then what is the value that people are still not able to see despite those huge volumes? So it's doesn't really make. And then high volumes and operator driven stocks, they are all similar characteristic. I mean every operator driven stock has to be high volume, right? So low volume, you see, what is the characteristic of an efficient market? One of the characteristic is that it should be highly liquid. So the reverse also holds true, that if a stock is illiquid, then maybe it is inefficiently priced. Not necessarily so, but basically at least it shows that there is lack of investor interest. And now there are many companies that I'm tracking since 10 years, and they never कभी भी volumes नहीं होते उसमें. So I like those kind of companies that firstly promoter has doesn't is not interested in his stock. There are no concalls. There is no fancy annual report with all that jargon, and so I know that there is no operator that is driving this stock, and the promoter is also not interested in his stock price. So I like such companies, and but then the flip side is that I mean either you chase up the stock price, or I just sit as a best buyer every day and I wait. If a desperate seller comes and gives his shares to me, I'm very happy. Otherwise, so it does not matter that even if I have a very minuscule position, maybe over a period of time I'll be able to scale up that position. So to begin with, it might be an insignificant position.
So, from whatever we've discussed, the type of companies you actually are looking at, people have never heard about. Also, we've seen that happen in a lot of small companies which you participate, and a few years down the line they get known, right? So, say one example is a company, because it's in the public forum which you've spoken about. You spoke about a couple of years or 1.5 years back in a forum, and now there are QIPs, there is investor interest, right? So, can you give us some examples wherein you suddenly lapped up? So there was older example, so there is no compliance risk, okay, where you suddenly landed up on a superb opportunity just out of nowhere.
Yeah, so if you take only, so I go through all the quarterly results as much as is humanly possible. So I am currently stuck on 25th May. So till 25th, I have covered all the results, and rest I am still to do. So if every 3 months I am looking at the numbers of all these companies since years, so basically a pattern emerges on its own. And as far as I was concerned, so first time I opened the results, and on the left hand side I saw the list of their stores in Bihar. So since I am originally from Ranchi, which is the capital of Jharkhand, which earlier was a part of Bihar, and many people in Ranchi have got connections in Bihar. So, and I knew that in retail, what kind of valuations are there in the market. So once I saw that this is a retailing company, so I called up people whom I knew in Bihar, and everybody said that yeah, they not only do they know about this, they have shopped over there, and they think it is doing brisk business. So actually, I called up many people in Ranchi and I asked them to figure out from those in, let's say, from Siwan, from Darbhanga, and such Gaya, small places in Bihar, uh, with their contacts. So, and everybody gave good reviews. So then next time when I went to Ranchi, then I just I traveled to a few stores in Bihar, and just from outside only you can make out whether this place is doing business, it's humming with activity, or is it just deserted. So yeah, so I could figure that out, that the business is genuine and stores are for real and they were doing good business. And at that market cap, it was like a no brainer. So yeah.
So okay, so actually, it's getting more interesting from the vantage point of the more I think about this. Uh, Managing a portfolio the way you do, you are by default not chasing the price, as you rightly said. You have to look at the value, and if you're comfortable with value, you buy and sit. Right now, when you buy and sit, there is always a risk of the company not finding its value for some time. You can sit at the similar price level for a long period of time, uh, and if that is the risk in the portfolio, I mean, sure, it's not a risk from your vantage point, but let me think from a investor perspective. If it's a risk you're taking, is it fair to say that this kind of a strategy should be done only with a highly diversified portfolio? Because otherwise, with a concentrated position, you can end up a risk of a large position not moving for a long period of time. Or you say that the similar strategy can be done for a concentrated portfolio. Would you do that? I mean, if you have an option.
I think concentrated portfolio of small caps is a risky thing to do, because firstly there is a, if you're managing public money, then liquidity is the issue. You have to be prepared that at any point of time you can have basically redemptions, and especially in a falling market, all buyers get out of the market and only compulsive sellers are left. So every day we'll be sitting on lower circuit, and our own selling will drive our stocks down further, and which will induce even more panic in our other investors, that every day these stocks are sitting on lower circuit, so let me get out before they go to zero. So that is the major thing that we want to avoid. So we diversify due to that. And you see, mostly what I have understood, that when my confidence was very high in 2018, so there was one company which did a share buyback at 575 rupees, and that share buyback was undersubscribed. Promoter did not participate. The public also did not participate. So then the stock went to 800. Then when on its way back, when it fell below 575, I thought that now at 575, company had done buyback, and today company has got far more cash on the books than last time it did buyback at 575. So it's a, and even otherwise valuations were attractive. So I thought that it's a low risk. Another buyback will come for sure, and the promoter was honest. I had met him multiple times, so there was no issue about the promoter. So, but the stock went to 300 rupees also, 250 rupees also, and he didn't do a buyback. And every year I used to ask him to do a buyback. So he got the impression that I am stuck in his share, So that is why I'm asking him to do a buyback so that I can bail myself out. Whereas I was telling him to do a open market buyback because it was in the interest of the company. So, but I mean, so on and so forth. I mean, they are, so the bottom line is that that buyback never came at 575. So what I'm trying to say is that nobody really knows how things are going to pan out. I mean, there was, so since in 2017 there was a huge bubble in small caps. So I shifted to, I sold a lot of small caps and I bought, which was a, basically it was a net stock and it had a huge dividend yield, and there was, every year there was a buyback, and I used to go to Ludhiana and ask them to do buyback, and the promoters were genuine people, everybody knew that. And so I thought that this is a good hedge in this kind of a market. This is a good hedge, at least I'm going to get some 15% come what may. Then what happened, that there was an announcement that the company is going to be merged with the parent company at 300 crore was the cash, with the company at 300 crore valuation. So, I mean, you can just get unlucky if you are concentrated. And so again, we created a lot of hue and cry that this is so unfair and this, that. So the promoters, being genuine people, they took back the share buyback, but then they stopped paying dividends. So a company which was paying on top of buybacks, they were paying dividends every year. They were zero dividend for few years. So what I understood is that you can never be sure that yeah, this is a nice promoter and he will. So and if you ask the promoter, he will say, "भाई हमने तो किया था buyback, हम तो कर चुके हैं इतने buyback." तो so I have understood the hard way that one can really never be sure. I mean, you can take your chances, that if you want to take risk, if I put all my money in my top holding, so my return would be far higher, but then the risk also, you can get wiped out also. And if you run a concentrated, if you have a concentrated portfolio position, then it's very hard to be rational and neutral and take a calm decision. But if it's a small position, then you can either exit it or scale it up as the case might be. So that also is one thing. I mean, not only is diversification a risk mitigation tool, it is also due to the lack of liquidity in small caps. And plus, if they are similar quality of companies at similar valuations, then, and nobody really knows the future, so why should I take a concentrated bet? So it's a mix of all these reasons. And also, if you see that study after study has proven that a diversified portfolio of even junk bonds outperforms the market. Diversified portfolio of your cigar butt stocks in terms of price to book value, if you make that kind of portfolio, even that will beat the market, because the company, some of them, they might go belly up, but the others that survive, they will give a huge return. So now the our effort is to make a diversified portfolio of small cap blue chip companies which are currently going through a down cycle in the business. So if I am able to make such a portfolio, then I think that portfolio should beat the market consistently. And since I don't really know that when exactly is the cycle going to turn in the underlying business, so that is why I'm taking a small position. And as the clarity emerges, because once you buy something, no matter, you might be tracking something, but once you buy it, you track it more closely. So as the things get clearer, so then we can scale up that position as we can see the cycle turning. So that is the endeavor, that we want to make a diversified portfolio of small cap blue chip companies which are going through a down cycle, and we call it quality in downturn. So basically, I want a company which, in which the business is intact. I don't want a company which is losing market share. I want a company which either is gaining market share or market share is maintained. It is just that the industry itself is going through a down cycle. So yeah.
Interesting. And that is how your name counter-cyclical comes into play, I suppose.
Yeah, you can say that. Basically, counter-cyclical is that we are not interested in popular stocks. We want stocks to become popular after we buy so that we can sell. I want to buy something from retail investors and sell to institutional investors. I want a company which is not holding calls, and after I buy, if it holds, I will sell. I don't like companies which are, what is call? Why are you so interested in jacking up your price? I mean, you just do your own business. I am really not a big fan of. I mean, okay, should do a call, that's fine. But all these small, tiny companies which are doing calls, I'm not their fan.
Actually, a lot of pressure comes from investors only to do the con calls, right?
Yeah, so basically, the promoter is also interested in that his stock price should go up, and I don't like that those companies in which the promoter is interested that his stock price will go up, because then you cannot believe whatever he's saying. If a company needs to raise equity capital, I'll not believe whatever the promoter is saying, and we never, as a principle, we never invest in companies that are they want to raise equity capital, because then I mean the promoter will say anything because he wants to raise capital. So yeah.
I've been trying to reverse think about the kind of companies which will be there in your portfolio. Okay, and actually, let me venture a guess, and then maybe you can correct me if I'm wrong. From what I've heard so far, it doesn't seem to me that you are a person who will bet on, what do you call it, turnarounds of any sort. Okay, so you are looking for
No, no, no.
businesses which are
We are.
already there.
Just to give you an
And
example.
yeah.
Okay, yeah, please go ahead. Please finish your question.
So just to add to that, so what I'm thinking is turnaround is probably not something you are interested in. What you're looking for is established businesses. Established businesses, you must be in some way judging from the profitability numbers and the cash flow numbers of the company to start with. And of course, within that, you are looking to buy them in the lower cycle. So they will be profitable companies, but lower margins at the lower end of the margin cycle. Is that a fair quantitative profile of the kind of companies you will have?
No, so I'll tell you with an example. So let's say there is a company. Now, again, this is not a recommendation, only for academic purposes. We are discussing these names. So this company, it made a lot of money in 2015. So that was the first time I saw this company, that this company is doing well, and I went to the AGM. And that time promoter was very upbeat that 500 crore hamari sale hogi, and this that we have plans and this that. Then what had happened in 2015? They basically export 60% of the egg powder from India, and they export to Japan, Europe, etc. And their main competitor is US. So the thing is that in US in 2015 there was some bird flu or something, due to which egg prices had shot up, and that's how this guy made a lot of money. And thereafter, the company stopped making money. It was almost as if no profit, no loss. Then in 2018, every year I used to go to their AGM, and the promoter used to say, no, it will recover and this that. Abhi destocking chal raha hai, it will come back and so on. Then in 2018, the promoter was in depression that nothing is happening. We are alive due to rupee depreciation. Otherwise, we won't be alive, because in India the demand for eggs is buoyant, whereas US may it's a saturated market, and plus in US GM soya corn is available, which is cheaper, and in India it's not available. So your feed is only more expensive. So basically, we are uncompetitive. Only rupee depreciation is keeping us alive. So I sold it at a good loss. Then last year I read somewhere that in US inflation, the breakup of inflation was given, and the egg prices had the highest inflation in US. So then it clicked me that okay, that company again it will make money because the prices of eggs have gone up in US. So I checked some more, and then we built it. Was for some time our top 5 positions. So so it was a turnaround only. If you say, matlab from hardly no profit, no loss. Now this company in 1 quarter it is making more profit than last 5 years combined. So yeah, so cyclical companies we like, and especially the ones that I have seen in the past and I understand the business, so I can join the dots.
Stoic Talks has been partnered by DSP Mutual Fund, which was an obvious choice for us, having interacted with the DSP team earlier and recognizing how they are obsessed with helping investors take better decisions. Some examples of their motivation to help investors do better are visible in their research related work, which they make available for free, including Getting Smarter, Tatya, Report Card, their Invest for Good blog, among others, and many more reports. We thank Team DSP for supporting this episode of Stoic Talks and recommend that you follow them on Twitter. Their handle is @DSPMF.
So there is one saying about you from your friends that you hate expensive businesses, hate quality businesses, and you're an encyclopedia of small cap companies. So how true is your hate for quality companies?
No, it's not quality. Whenever
Or
you see-
expensive companies,
now
rather.
there is one company which makes, let's say, so whenever you hear that this is a B2C business and they are selling in US and the competitor, so that is the time to sell this stock. And whenever you hear that promoters are crook, that is the time to buy this company. But the fact is that both are true. Now, how big a crook? That's something that actually that's the problematic part, because you don't really know. Look, business is genuine. That's not the issue. The again thing is capital allocation and the greed of the promoter. So a greedy promoter, you don't know what he will do next. So I had bought again in 2018 due to overconfidence. There is a company which has got 50% market share on boric acid, and I knew this. I was tracking this company since a long time, and I knew that the promoter is the crook. I had met him in the AGM, and he's a very soft-spoken person. Even if you go and abuse him on his face, he will just smile. So but the stock was very cheap and they had huge cash balance, and I got an impression that the corporate governance is on the mend. So this company had diversified into real estate and made investments in real estate. Then the promoter told me that no, henceforth we will not do anything, no more real estate investments and this that. And I every year I used to ask him to do buyback, and I had 3% equity in this company in my own family's name in 2018. Then in 20, so every year I used to ask him for a share buyback, and he used to say, yeah, we'll consider, we are considering. And then on 15th March of 2020, announcement came that they have bought a 42 crore worth of flat in Pali Hills, 5 BHK, where now the promoter must be staying with his family. So I made a loss of over 1 crore in that company itself. And then to rub salt on my wounds, that stock went up 10 times in the next 1.5 years due to it was chemical, very good prospect, chemical store. I mean, what chemical? When the promoter, yeah, chemical promoter will become rich from chemicals, shareholders, nothing will happen to them. So that's the problem in companies where there are corporate governance. Even if the business is real, if the promoter is a crook and if he's a greedy person, you don't really know that tomorrow what will he do. I mean, till the time I had bought, he had only bought luxury cars. Auditor was his wife's relative, and what else? He had bought real estate, and he used to draw humongous salaries, whereas the dividend was flat till since 2007 at 1.5 rupees. And after he bought 42 crore flat, then the dividend was increased to 10 rupees.
So there are many such interesting cases, and say because I've tagged the line called Chor Bane More when it was 2015, and by end of it, it became an investment strategy. But that is the fact in Indian companies. There is always namak mein dal hai ya dal mein namak hai, nahi samajhta. But so tell us some cases where you actually saw things change, right? Say you've gone through an AGM for 10 years, and did you see some change, and because of that you ended up making a lot of money, or some cases which were very interesting?
So let's focus on cases where I lost money. So there is this company, they have cello brand. So this company I had bought in 2010, and it was at single digit P. And I had gone to Daman, and I had met the promoter and everything. And at that time they had just one leased one leased plant in Daman with two second-hand machines and one plant in Batti for bubble guard. Now, then I sold this stock in 2015 at some 50 PE or something like that, 2015 or 16, thereabouts. Then again, when the stock started falling, it made a high of some 1500, 1600, 1700 rupees or thereabouts. Then when it fell below 700, again I went to the AGM and the promoter was full of कि हमने डस्टबिन लॉन्च किया है 150-200 करोड़ तो यहीं से सेल आ जाएगी 2 साल में और ये हो जाएगा वो हो जाएगा. He was totally upbeat and I thought that I knew this company and this promoter is good because by that time, this must be like 2018, from 2 plants they had already gone to 9 plants and company was totally debt free. So from its own internal accruals, company had grown the business. So I had very high regard for this company and I thought that this is a high quality company and their margins were always superior than the competition throughout. Then so I thought this is a टेम्पररी इशू एंड द प्रमोटर ऑल्सो सेड कि जीएसटी में पहले 28% रेट था तो इसकी वजह से ये हो गया वो हो गया और अब ये सब रिजॉल्व हो गया है. सो एवरी ईयर ही हैड अ वैलिड इशू, वैलिड एक्सक्यूज. So I thought, okay, I should give him time. So stock kept on falling. I kept on averaging out, and then cash had accumulated in the balance sheet of around 200 crore or thereabouts. So every year I was asking for a share buyback. So finally, what happened? And meanwhile, the promoter shareholding fell from 75 to 55%. So some people got declassified as promoter. Then finally, last year or this year, earlier this year, notice came that promoter wants to give 100 crore loan to promoter group and 100 crore guarantee. So that was the time I sold this company. But I still don't know that what would I have done differently. I don't know. I could have just so I had at peak I had 3% weightage of this company because I genuinely believe that it's a high quality company. And if you look at just numbers and everything, and if you separate cash, then actually it's a very high return on capital business. It's a branded business. So, but then if the promoter only out of nowhere, if he's and now it seems that it was all planned. I mean, the promoters that were declassified and that resolution, special resolution to loan the monies to the promoter group, it barely passed. I mean, just by a whisker it passed. So because those people who were declassified as promoters, they voted in favor. Had otherwise they couldn't have voted had they been had they remained as promoters. So that resolution wouldn't have passed. So the promoter had plans to basically fleece the shareholders. But I mean, I don't know what I could have done differently. So that's why I have realized that it's best to run a diversified portfolio so that I mean these things can be taken care of.
Yeah, actually, I was about to ask that only. So, did I hear it correctly? You said your maximum position in this stock was 3%.
Yeah.
Okay. So when you said 3% and you kept on buying as the stock fell, is there by default? I mean, of course, you run a very diversified portfolio that by default makes that you will not have enough cash, to keep on buying because you have so many stocks.
We are fully invested.
Fully invested, right? So generally, when you are buying, you probably will be selling something to buy something.
Yes.
That will be one of the. So that inherently there is a hedge that you need to sell something to buy something. So by default, you would probably not be selling a lot of ideas. So not buying a lot of particular stock. Do you by any chance have a maximum also? That okay, I don't want to go beyond 5% in any name whatsoever. Given that you want to.
There's nothing like that. Again, 2016, I took a concentrated portfolio. That time it was only my family portfolio, but I bought 26% in because I had attended the AGM and I had sat with the promoter for 2 hours and he was gracious enough to explain the business in detail. And I saw that there are simple people. I mean, you look at their office, you look at the cars that they were using, and they really in drum closure business. Had it been a standalone business, that business alone would be more than the market cap. And then finally, I asked them to do a share buyback, and actually they did. Also, they made a. After that, I started buying because the stock was in 200 rupees. Buyback had already been announced at 270 rupees. So it was a kind of a arbitrage thing that I thought that 20% of my shares will, approximately 15-20% of my shares will go in the buyback. And for the rest, I mean, it was good risk. So yeah, so if that kind of a arbitrage kind of a situation is there, or if I'm confident about the promoters that at least they're genuine people and the business is also solid, and if it is available at a good valuation, then I'm happy to take a reasonably concentrated. Now concentrated is also relative. It can not be 26% of portfolio, but maybe it can be like 5%, or it can even be 10%. But it's actually case to case that what is the trigger and how soon is the trigger. Now this also, it's not a great corporate governance story. It is just that there was a immediate trigger. So
Okay. So, in the last 3 years, what's the maximum you have seen in terms of allocation in a particular stock? Just to gauge from the time you're
12%.
managing public money.
12% it went because we didn't put 12%.
Okay.
Since the stock went up, that's why.
Sure. At a cost level,
Cost level haven't.
difficult to.
Like
That's fine. Yeah, I understand. Okay. One thing which has come up again and again and again in our conversation is that you are very value focused. One thing which is very clear. Can you give some perspective on how you go about? See, again, I understand valuation is a very commonsensical exercise and not a mathematical exercise, so to speak. But when you are having a view on valuation and you want to be very conscious, how do you go about? You can take some examples and give us an idea about how you think about valuations. And add-on question to that is, when valuation starts to go berserk, not for allocation, because you don't seem to care about allocation too much. I think it's more about your valuation which becomes uncomfortable, which might lead to selling. Is that a fair understanding? Are you selling only because of valuations or something else?
Yeah, we are early to the party and we leave early. I don't want to participate in the last lap. I want to sell my cyclical stocks when the sun is shining. I want to get out at 12 p.m. मुझे 3 बजे तक I don't want to wait. I exit early and I enter early, and because after a while it is just speculation that I mean, once it is beyond your valuation comfort and it is just momentum, like let's say defense stocks now, so just the momentum is is increasing those stocks. So now I have no way to figure out that I mean, I have sold stocks late last year and they have doubled. I'm talking about defense stock. So, but that time also what I was buying, I thought that the switch made sense. I mean, fundamentally speaking, and but of course, yeah. I mean, with the hindsight, I mean, nobody knew that this kind of defense bubble or whatever you want to call it, that's going to happen. So yeah, so as soon as if I can find something better, I'll just sell and move on, because otherwise,
can you pick out some of the good names which you already mentioned, or maybe some more names where, with some perspective on numbers, how are you evaluating it on the valuation front, and what kind of valuations you are absolutely comfortable with? Just a broad idea would.
Say, taking an older example where you say bought at XP, sold at YP, or say, how did you go about the whole cycle of buying and selling a company?
The question is to give the listeners an idea about a quick hand analysis on the valuation front, with some examples, if it's possible.
so let's say that firstly, I will only give weightage to cash or mostly cash if the promoter is genuine. If the promoter is not genuine, then there is no cash. And even if the promoter is genuine, you need to take out a quarter of the cash because even if the company does buy back in the best case scenario, that's got to go to the government. So what I basically in a cyclical stock, what I look for is that what were the previous peak earnings. I mean, it is true that it's not necessary that, let's say, in the next upturn, it's not necessary that will again make the kind of money that it made few years back. You see, it depends upon cycle to cycle. But still, if a company has made that much money in the past, okay, in the past cycle, so I can take it as a benchmark. I mean, one has to really adjust it. Like I already said, that it's not necessarily Graphite India will again do that much. But let's say, for example, or for that matter, any cyclical stock. So it's like saying, if a runner, if he has completed that race or that track in a given time, so that he has already done it in the past, so he can do it again. It's in the realm of possibility. So that is, I mean, to begin with, that is what I look that. I mean, let's say any stock, let's say like chemicals are in a downturn now. Okay. So if you want to take, so look at its peak EBITDA and compare it with the market cap. That is it, if in some subsequent year down the line, the company will surpass its previous. First, the question is whether it will or not. I mean, if it was a cycle like, if you see post COVID, the kind of money the ship liners made, I mean, God knows when they will again make that kind of money. I mean, I'm not asking you to take that as a benchmark and value those companies, but the problem in stock market is that everything is on a case by case basis. There is no generalized this thing that I can give. But what I try to see, if the promoter is genuine, I look at EV to cash flow yield. I look at EV to operating cash flow, and that is my basic yardstick. But that I will only take now. I have made a lot of losses that if you buy shares of crooks and those who have got a lot of money in the balance sheet, and you minus that from the market cap, and then if you see it's trading at 1-2 time EV EBITDA or even 5 time cash flow, but that cash is going to vanish one day. So there is this company, again, Bhavnagar based company, Mr. I had met him. He's a very small, soft spoken gentleman, and he had work in precision cast parts during in US during his internship days, which subsequently Buffett bought and so on. And he was a, I mean, if you talk to him, the feeling I had that this company, and if you look at the company's numbers, so they used to make over 30% margin, and their realization per gram and this and that. So business was high quality. And again, I used to ask them to do a share buyback. Instead, what happened that they acquired two paper companies of the promoters, and they had no assets whatsoever. And on EV basis, they paid something. I think altogether they paid some 40 crore or thereabouts, because the companies that they acquired, they had debt also. So basically, all the cash vanished. And I still don't know what I would have done differently, because the promoter was genuine. You look at his track record, look at the numbers of the company, everything was above board. There was no problem. So how do you know tomorrow what promoter is going to do? And at least in the case of that boric acid company, I knew since the beginning that this promoter is a crook. And but I thought the corporate governance is on the mend, or at least the promoter was telling me that no more real estate investments. But here, I mean, to begin with, the promoter was a genuine person. If you speak to him, and there was nothing to suggest that hanky panky is going on, because there was no hanky panky before this event. So basically, the more I have seen the markets, the more I have realized that things are basically unpredictable. You can basically take your chances. You can run a concentrated portfolio and you can get lucky, or you can get unlucky. But really, I have not been able to understand till now that what I could have done differently in, let's say, except for maybe a smaller position.
It's very interesting to see that you've spoken about all your, say, places where you've lost. And the fact is, over the last 3 years, you've made a killing across the board, even with a diversified portfolio. Say the returns have been crazier than one could think. So that is, I think, is your focus in terms of minimizing your mistakes instead of glorifying what you've made out of a lot of these small caps. Because all through this discussion, we are only hearing about where you screwed up and not the place where you made 10, 20, 50 baggers.
That's what make it a very good learning session for all of us, actually. Actually, one very interesting thing which I found is very rarely I have seen PMSs doing this kind of a diversified work, because a lot of, what do you say, a pitch is superior stock selection and not superior, returns coming from superior stock selection, whereas your way is very different, which is, I don't know which one is going to do well, but I know these are good companies. Let me have all these companies and let's wait for them to do their job.
Yeah, nobody could have. I mean, now let's take a company like some years, quite a few years back, they sold a huge land parcel, their erstwhile factory and so on. They got a huge amount, and from that money, the promoter was buying a sea-facing flat, and all that company was buying, and the promoter will live. So, I mean, I just stopped tracking that company then and there. But then subsequently, returns have come in that company also. So it's very hard to say that. I mean, so that's why I've learned that I can take a I'll never buy a large position in such kind of companies in which I know the promoter he's a greedy person. So let's say that I can take a large position in companies in which the promoter is a genuine person, and basically he's, even then one cannot be sure, because if someone can point out to me that what annual report you read and what was he doing, what hanky panky, there was no related party, nothing was there.
I think the same company you're talking about is in news for something else in the recent times.
I don't know.
I think you should go and check. It is a very funny incident which has happened in that company now.
Okay, I'll check.
I don't want to talk about it, so we'll keep it off record.
Yeah, but all these companies, this is just my opinion. I might be wrong.
Yeah, absolutely.
Companies, promoter might be the greatest person in the world. It is just that I have made a loss, so maybe I am crying, maybe I am cursing them. But please, I'm not blaming anyone. They are all my mistakes, and I'm solely responsible. So I'm not.
Okay, so there is an official disclaimer for all the listeners that all these are for education purposes only.
Yeah,
and
yeah.
So any examples where you got lucky, where you thought this could not happen and this happened?
No, many times you get lucky. I mean, many times bull markets bail you out. I had bought a company in, I think, 2017, when again I went. That company used to lay down pipelines, and that was a good, well-run company. At least the numbers one could understand, and its current liabilities used to fund its current assets. So there was not much capital of the company that was deployed. So I went to Delhi. I met the promoters, and I got a very bad feeling after meeting them. And but still I was holding, because 2017 everything was expensive. Then what happened, the revenues of this company started falling, and twice a year the balance sheet comes. So when the next balance sheet came, the receivables were more than the revenues of past 6 months. So I thought that I am now basically I'm stuck over here, and I'm going. God knows, after I saw those results, I thought that I don't know at what price I'll be able to sell, but I will sell at any price. So because anyway I was, I was disenchanted with the promoters, because they had diversified into clutch plate and all that bullshit. So anyhow, but instead I sold it at a profit, because it was 2017 and there was a huge bull market. So I don't want to name the investor who bailed me out. I read in the blog deal. But yeah, so I got lucky. I was thinking that I don't know at what price the stock was at around 140 rupees. I had come to terms that it will go. I will take it down to double digits, and but I exited at a profit because somebody did not really see the numbers properly, and so I'm thankful.
I actually, again, while you're saying, some questions are coming to mind, but one question which I generally ask everybody is that, and in your case, makes a bit more of a case, is that, let's say 2017 market, you are in an overvalued, from your vantage point, it will be even more overvalued than you're comfortable with. Why not cash? I mean, why not you consider moving to cash because the alternate positions are kachra or something which you might not be very comfortable with from quality perspective. Is there a viewpoint there, or is it a conscious decision of never to go in cash? Any views
Look,
on
I
that?
will never say never. I think in a market like 2007, I will come to cash if there is nothing else to buy, and I'll return the money to my investors. But otherwise, I'll shift to large caps, maybe
Otherwise,
PSUs
shift to large
or
caps.
something
Okay.
like that. But I will exit small caps if there is every 10 years there is a bubble in small caps on an average, and whenever that happens next time, and this time I have resolved not to buy cheap stocks at the top of the bull market. I want to at least buy decent companies in which the business is growing, and at least there should be comfort. I can so that I can sleep well. That while I'm sleeping, the business is growing. That should be the feeling, not that while I'm sleeping, someone is stealing from my pocket.
So, say from your observations over the years, you've had a concentrated portfolio, diversified portfolio. Uh, does diversification help on the downside, the market cycle? Really, because everything falls, right? We've seen in various cycles. Or is it the comfort you get from diversification that, all right, will be at least able to sell?
Look, it's a mix of both. In running a diversified port, firstly, it makes the life of the fund management team far harder. If you have 10 stocks, then you just need to follow 10 stocks, and rest you can do marketing, you can write newsletters, and so on and so forth. But if you have 100 shares, then you have to keep on tracking those 100 shares. So it's a very difficult, a relatively more difficult thing to do. But then since I don't take it as a job, it's my hobby and passion. So I don't take it as a work. So it's my hobby. That's why I do it. Now the thing is, the flexibility is that if, let's say, I have got company A and company B, I have made 1% allocation in both. So what does that mean? That means, by and large, I think both are of similar quality and similar valuation. That's why I have put the same weightage, right? Otherwise, if I felt that company A is of higher quality and similar valuation, then why would I have kept the weightage same? Now, similar quality, similar valuation, you can still say, but similar quality, it's a subjective thing, you see. I mean, what is similar quality? So, but by and large, I mean, just for from my own this thing I'm saying. So now let's say that there is no fundamental change happening, everything else remaining the same, no new information, it's just a bull market. Company A is up 20% and company B is up 50%, without any new development. So I can sell company B, which is up 50%, and increase my allocation in company A, right? And let's say in a falling market, again, no new development. It's just that company A is down 20%, company B is down 50%. So I can sell company A and increase my allocation in company B. So that flexibility is there with me. But if I have already to begin with, if I have got 10% weightage, then how much further can I take that weightage? I mean, at some point of time, it's a leap of faith, and it's not prudent to do that, because I mean, all the cases that I have cited, in which I really don't know what I could have done differently than to buy a maybe smaller weightage.
Smaller than that. That would have been a
No, I mean,
difficult thing to
instead
do.
of 3%, I could have bought 1%. I mean, and that too with the benefit of hindsight. I mean,
Hindsight benefit,
but
sure.
actually, I made that 3% weightage because I thought that it's a blue chip company, it's a branded consumer, high quality company, and I know the business and that it's in a downturn. But who knew that the promoter will do this kind of a thing, of which there was no previous, it was out of the blue. So if you look at, it was out of the blue. What promoter might do tomorrow, who knows?
So interesting is that say when you talk about these names, you have such a lot of diversification. One thing we were very clear that you buy cheap, right? So what is the thumb rule you have for the upside? Okay, this is what I would not like to pay, say EV by EBITDA or some number where you say, okay, now this goes beyond my radar. What sort of valuations or say change in valuations, etc.
I mean, you see, it's relative. It's hard to give a clear cut. Mostly, I try to buy companies that have got good market share. Even though they are small cap, they have good market share and they are not losing that market share. And that, like I said, I try to see how much the company has made in a normal good year. Okay, not a exceptional year like, let's say, the 2 years back. So that I can, since you see in a cyclical downturn, earnings for more or less they just evaporate. There are hardly any earnings, right? If you look at chemical stocks and dyes and pigments and so on, at this time, either companies are making losses or they are making minuscule profits. So how do you? I mean, only way to figure that out is to see that in a one full year of what was the peak earnings that the company made before, and whether the company and how far the prices of the underlying commodity have fallen since, you see, and whether is there any likelihood that those prices will come back again. I'm talking about the underlying commodity. And if so, then on a higher base, because most companies keep on expanding capacity. So then on the higher base, when can this company surpass its previous? So basically, the stock should be at a bargain to its earlier earning capacity. You see, it should be cheap if we assume its previous earnings. You see, so if you just if you take that all these your underwear manufacturers, I'm not talking about the next three. If you compare their FY23 earnings are they have just evaporated, margins have been slashed and so on, volumes have also gone down. So now, but if you can take their FY22 numbers, that when you feel that they will be able to, how does the market cap look if we compare it with FY22 numbers? Okay, that is a starting point. Then the question is, how soon can these companies come back or surpass their previous peak earnings? But what I want to see is that this much company has made in the past. Okay. I mean, if it is due to exceptional circumstances, then, like I said, it's very hard to give uh, one size fits all answer, because all these things are case to case. If the prices of the underlying commodity are not going to reach anywhere near the levels of the past, then I mean, all this is in vain.
Just to get some rough idea, Keshav, 2018 onwards, we saw a big crash in small cap, small cap names. I mean, the whole index was down some 50%, if I remember correctly. Small cap index, BSE small cap. Uh, since you are 100% invested and you have always been 100% invested, the kind of portfolio do you construct? What kind of drawdowns you saw in your portfolios broadly? Again, not an exact number, but
When?
what, in 2018, 18 to
Yeah,
20
so that
crash.
time there was no PMS. So from my family portfolio fell from peak of 55 in Jan 18 to 24 in March 2020.
Okay, so pretty much in line. Why I'm trying to ask this question is because from pretty much what Nuresh asked earlier also, that whether this kind of a diversified but good quality small cap portfolio, does it provide a
It was
hedge on the
not, it was
downside at all or
not,
not?
neither was it good quality nor was it diversified.
Acha, हाँ, you okay? 2018 was slightly more concentrated.
And say now you're running this portfolio at a particular size, your AUM right now, right? Where do you think it becomes a cap, your strategy, or your planning, say going forward, you're ready to change with the kind of, say today you have, so I've seen like say you have some company which is like 20 crores market cap also in that portfolio, and there are companies which are much higher this thing, and overall your AUM etc. So do you think there's a cap to your strategy of buying into small caps? Okay, this is a cap where I would say I don't want any new money.
I mean, yeah, if I think that will primarily depend upon the valuations, not on the size of the AUM, because until and unless I'm able to find like even 2,000, 3,000, 5,000, even 10,000 crore market cap companies, provide they something should be available at a good price. But if nothing is available, then even a small amount of money, and in any case, you see, whatever money we are managing, it's fully deployed, right? So the question is only of the incremental money that I have to deploy. It is not though that every day I have to invest all this 375 crore. It is just maybe 50 lakhs every day or something like that that I need to find a place to deploy, right?
Makes sense. Makes sense. But anyways, Keshav, it was a very different kind of conversation than usual. Very different style, to be honest. But I'm pretty sure a lot of people will take a lot of interesting learning, especially when it comes to small cap, mid cap, and I mean, amazingly, when you talked about the importance of the diversification, because majority of the PMS focus on the other side of things, so it will be very insightful for a lot of listeners. At least for me, there were some really interesting takeaways, which I'll keep to myself for now and mention later in the blog probably. But thanks for your time, Keshav. It was really good talking to you. Nuresh, if you have any questions, otherwise I would. We've already taken a lot of time from Keshav.
Yeah, so I would just like to thank you, and it's interesting to see different perspectives of way at looking. Say, there are few people who go the AGM way, like you do. You go small caps, micro caps, so that it helps learners. There's not single way to make money. There are hundreds of ways, and yours was one more interesting one for our listeners. Thanks a lot for the time.
Thanks, Nuresh. The pleasure is mine. Thank you very much. And once again, please, this discussion was for academic purposes. None of the companies that I have named am I alleging anything on the part of the promoters. I think they are all good people, and things should be seen in context. Thank you.
Thank you.
Perfect. Thank you so much for your time, Keshav. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.